All right, what is up, traders? What's up, tycoons? We cannot ignore the bearish data anymore. So we're finally going to cover a little bit of the bearish data for you guys. Go over the income needed to buy a house at a all-time high right now. We'll take a look at how housing is less affordable for renters and buyers alike, and how basically we've seen inflation just go up, right? And this is some data when it comes to food. And then we'll also talk about the lagged impact that the Fed funds rate has and the time that it takes to actually hit stocks. Okay, so it's very, very important, but this doesn't have to necessarily be bearish for something like TLT. We'll break down that data. If you also take a look at the S&P 500 minus the S&P 500 equal weight returns right now, this is a very scary signal right here. Okay, and we'll break down all of that data in today's video. So be sure to smash the like button and subscribe to the channel for more. As always, we're going to break down TLT, give you guys my thoughts and analysis on it. We'll take a look at the 10-year treasury yield, which is something very important. Typically, if you're trading stocks or if you're trading bonds, you generally want to pay lots of attention to treasury yields, and the 10-year is the most commonly looked at. Now, if you're new to the channel, I did start a completely free newsletter for you guys. It's called Investment Intelligence, giving out free valuable finance content, free trade ideas as well. And you can get those directly to your inbox. And these are what the trade ideas will look like, right? Highlighting the chart conditions, going over the signals on the MACD or the RSI, any indicators, chart patterns that we're looking at, and giving you guys an idea of where price action could potentially head. And as you can see, this rising wedge here played out very perfectly. I try to put in quality over quantity. So what that means is that, I'll sprinkle in 1 to 2 free trade ideas every single week for you guys in the newsletter. Rather than me spamming your inbox with 5 to 10 different stocks every single day and, praising how one of them went up 10, 20% in a single day, these are going to be high quality swing trade ideas that you guys can look forward to. So if you're fans of free valuable content and free trade ideas, you're really going to want to sign up for that newsletter. I also have the Investment Intelligence Discord. That's where you get access to all of the different trade ideas, not just the newsletters, right? So, Rivian was a newsletter trade. Okay. Many of these, we talked about Tesla a few times in the past, but there's some other trades in here like Carnival, right? We had Neo, SoFi, Toast, many other different plays that were available to the members of the Discord in the trade ideas tab. And in there, you actually get access to not only the trade ideas, but all of the custom scripts and indicators that I use to, set up my day trading strategy for trading the S&P 500, where we can get these really nice returns trading options. So you can join the Discord. It's $10 a month. That's less than a cup of coffee a week. It's really nothing. Otherwise, just join the free newsletter. Either way, you're going to be provided very valuable content. Now, we're going to start off here with the income needed to buy a house. And if you take a look, it's over $100,000 right now. Now, keep in mind, inflation has continued to, hit the US economy for decades, right? So obviously, you're going to need less money to buy a house in the 1970s than you would in the 2000s. Okay, so we do have to just figure that in, right? But this blue line here does a really good job of showing you guys the median household income. So you can see, typically in the 70s and heading into the 80s, it was very affordable for someone in the US to buy a house, right? It was below that blue line here, meaning your average median household income, your average median household, they could typically afford a house. And then there are these periods here where it gets a little bit overextended. And you can see here, we're just astronomically high, right? So currently the income needed to afford a house is much higher than the median household income. Now, this is really pretty crazy. And so assuming the payment won't exceed 30% of the buyer's gross income, the income needed to afford a house at today's price and mortgage rates is around $111,000. Meanwhile, the median household income is only $78,000. So, it's really shocking, and, it's hurting a lot of people right now. And that, affects renters and buyers, right? It's really both of them. So housing is less affordable for renters and buyers alike. If you look at the monthly Zillow rent index, it went up 28% since 2020. If you look at, the 30-year effective mortgage rates, it went up 4 percentage points. That's dramatic, guys. That's basically 100% increase in, your mortgage rate. Okay. And then you look at the Zillow home value index, it's up 42% since 2020. So, let's just say for numbers sake, if there was a house that was $100,000, well, now it's $142,000, and you have to pay 4% higher on your mortgage. And if you're just trying to rent alone, the rental rate is also up dramatically. So it's impacting a lot of people, not just people who aren't home buyers or people who are first-time home buyers, but also people who own homes and are looking to get a new house, right? And maybe their family has increased, maybe they had a small 2-bedroom house, and now they have kids, and maybe they're looking for a 3 or 4-bedroom house. And the price of the homes have went up, the mortgage rates have went up, and it doesn't really make much sense for a lot of people, if they do own a home, to sell their 2, 3, 4, 5% mortgage rate and hop into these really high extreme mortgage rates that we're seeing right now. And this is something that's very troublesome, for the U.S. I mean, if your average person can't afford a home right now, that's not a good sign for the economy. Now, prices have gone up and many other things. We all know about inflation. Now, inflation has started to cool, okay? But keep in mind, inflation cooling, okay, so inflation going down does not mean prices are going down. What this means is that the rate that prices are going up at is decreasing, right? So let's say this is your rapid increase in inflation, and then you start to see it go like this. And so now inflation is not going up as much anymore, but compared to the levels that it was at, it's still increased higher. And you can take a look here at menu prices from 2020 to 2023. Chicken dishes are up 30%, burgers are up 23%, pizzas up 17%, and pasta and noodles are up 14%. So, we're seeing not only homes more expensive, we're seeing food more expensive in many other areas of the economy. And when you talk about the stock market and you take a look at the lagged rate impact that it takes times to hit stocks typically plunge many months after rates peaked in the past. Now we're at this point right now. Okay, the big question in the market right now is, has the Fed funds rate actually peaked? And that's what many people are pricing in. And the stock market's been rallying very tremendously here. And what's happening is people are actually pricing in rate cuts. Okay, so you see these areas in blue right here. This is the Fed funds rate. You can see where it actually starts to cut, right? A Fed rate cut means this blue line starts going down. We don't experience recessions until times after the Fed is actually cutting rates normally. So if the market is rallying right now, pricing in Fed rate cuts in March, you have to ask yourself the question, well, what could potentially happen in the third and fourth quarter of 2024? Could it potentially be a pullback in the market, and could we potentially be seeing a recession in the later half of 2024, potentially even 2025? We're going to get a lot of data this week coming from the Fed, and we should get a new summary of economic projections and really get a good idea on whether or not the Fed is potentially actually looking to cut in March, or whether they're going to cut, maybe in the summer or Q3 or Q4 of 2024. And that's going to have a big impact, right? They typically are not going to cut until things look really bad in the economy and until things are broken in the economy. And the way that the labor market has just been holding up very, very strong, the Fed does not really see a weakening economy at the moment. Now, GDP forecasts are going lower. Okay. We have, the labor market is softening a little bit. Okay. And we also have inflation coming down. So it's not like we're in this strong booming economy right now, but what we do have is a very, we have an economy that's holding up very well right now. We have a very resilient economy with, even though we faced all of these obstacles, the economy has been very resilient throughout this. And so, this is painting the picture of a soft landing. And, this is something that you do want to be cautious of and be worried about. Now, when you take a look at the S&P 500 minus the S&P 500 equal weight rolling 1-year returns, we're seeing this period here now where a lot of people are championing and rallying and, really embracing the fact that the equal weight has participated in this most recent rally. The big narrative in the beginning of the year was, well, it's only the Magnificent Seven stocks that are rallying. And that's not the case that we've been seeing here recently. Okay, we've actually seen a lot of market breadth. We're seeing a lot of the laggards in the stock market catch up, and we're seeing, multiple stocks having 10% rally days, and, really just catching up to those Magnificent Seven stocks. Now, What's concerning about that is if you take a look at these periods where we have these really sharp returns in this value right here, and that's 1999. Well, we all know that the dot-com bubble happened afterwards, right? We see 2020 right here, and then we know we had a bear market there, 1990 and 1973. So this is not something that's necessarily a bullish signal for the future. Okay, is actually, typically it's very common to see outperformance and the performance of the S&P 500 being carried by the best stocks in the country at the moment, right? And so that's something that you can't really necessarily hate on and say, oh well, it's only the best companies in America that are really rallying and carrying the stock market right now. I mean, that's, if you think about it from a common sense standpoint, that's how it should be. So whenever you are seeing all of the other stocks in the stock market outpacing, and we're at this level right here, at the S&P 500 minus S&P equal weight rolling 1-year returns, this has been a good signal many times in the past of like, hey, maybe we need to be a little bit cautious. What's the reason really why maybe the top companies in America aren't really outperforming relative to the other ones, and why are these other ones performing so well? And that's just something you want to keep in mind heading for the next year in 2024. So with all of that being said, the big question now is that actually bearish for TLT, or is that bullish? Remember, bonds are very interest rate sensitive, okay? And, just as a matter of fact, they're going to move opposite of treasury yields. So if we were to simply just take a look at this tremendous rally that we've seen in the TLT, and then take a quick glance at the 10-year treasury yield, the TNX, we can see that there's also been a very strong downtrend. So if the market is pricing in rate cuts for 2024, and let's say, the Fed does start to cut rates in 2024, the big question we have to ask is, how is this going to impact our portfolios? Well, if the Fed is cutting rates, typically you would expect to see your 10-year treasury yield go down, okay? And you would expect to see something like TLT go up. So many times in the past, the stock market and stocks have fallen after the Fed is cutting rates, because again, the stock market will be forward looking. The Fed is trying to be as forward looking as possible, and they're saying, hey, things don't look good in the future for the economy. And so we need to actually start cutting rates and start, stimulating the economy a little bit, right? And so if they're doing that, the stock market will say, hey, maybe the next 3 months, 6 months, 12 months don't look as great as we thought they would. And then they start to sell off because they're pricing in the future, right? And so at this point, when treasury yields are going to be dropping, something like TLT is going to be rallying. And this is something that I've mentioned for a long time this year, is that, hey, if you're looking for something to hedge your portfolio, right? Because treasury yields are going to continue to rise higher as we're getting, as the economy looks strong, right? If the economy is looking really strong, the treasury yields are going to go higher. And now we've seen a lot of the data soften up a little bit. We're seeing the labor market soften up a little bit. We're seeing treasury yields, we're seeing inflation soften up a little bit. And, while the stock market is initially rallying off of these things, it's because they're pricing in the Fed rate cuts ahead of time, right? And right now they're pricing in rate cuts in March. So keep that in close mind, right? If we don't get rate cuts in March, the market's going to have to reprice things in. And then think about this. If the stock market continues to rally into March and they priced in those Fed rate cuts in March and we get those, well, now the market's going to be forward looking again. And what it's going to say is, okay, well, 3, 6, 9, 12 months from now, what potentially could happen in the economy? What can happen to companies' earnings? And that might be a point where if the Fed is cutting rates, they see something very, troublesome in the economy. And it's very possible that that could be a bearish catalyst for stocks. Now, that doesn't have to happen, right? It very much is possible we can get the soft landing scenario. Okay. The Fed historically does not have a great track record of pulling off a soft landing. Okay. But you do have to keep that in mind that, hey, this time could actually be different and we could potentially see a soft landing and the market could continue to rally after we get rate cuts. But you also want to pay attention to the historical data and say, well, hey, Typically, when the Fed is cutting rates, a recession follows afterwards, and we end up seeing a pullback in the stock market. So you want to pay close attention to that. Now, when we go into specific levels for TLT, we're basically battling 94.74 right now. We hit overbought right here. This red line on the RSI, this is overbought. So it's no surprise that we're seeing TLT pull back. There's a gap down to fill, okay, right around $93. There's another gap down to fill right around $88, and there's another gap down to fill right around $85. So we have 3 gaps to the downside to fill on TLT. And it's very possible that we could get these gaps to fill. Now, the recent jobs report is the thing that actually caused TLT to drop so hard this past Friday. Okay, and that's very evident here as well in the 10-year treasury yield. Okay, now things are lining up with technical analysis very well at the moment. Okay, we had this bullish channel that we've been covering for a while, and we're looking to see where we're going to get a breakdown retest and push lower and come down to our targets. And you can see we came right down here to the 4.128 area. We found support there, and TNX has actually started to bounce. But remember, this was only because of the jobs report on Friday. Okay, so with CPI coming up very soon, if CPI was to come in hot and inflation was to come in higher than expected, it's very possible that we could actually get a change in the trend, right? So the trend has been obviously very bearish in treasury yields, which has obviously been very bullish for something like TLT. Okay, and one bearish day does not start a new downtrend, right? So the trend is still very clear here, right? It's very bullish. We haven't broken this trend and reversed and gone lower like we did here on the 10-year treasury yield, where we had the clear uptrend and then we broke through there, retested, and pushed lower. That's not what we're seeing in TLT. So it's not necessarily the time to short TLT right now, just because of the recent pullback and just because it looks like it's starting to reverse. Okay, it may drop a little bit, but ultimately Tuesday is going to be very important. All right, if the CPI data comes in very hot and it comes in high, that's potentially when we could see another gap down in TLT, and that's when we could potentially see it break this recent uptrend that it's been trading in, and then we would look for a pullback to these potential areas. Okay, we have 90.88, 89.27, 87.67, and then of course we have the gaps down that I mentioned, and one all the way down to 85. All right, so those are going to be areas to look for if we break the uptrend. Now, if CPI comes in good on Tuesday, remember, this is most likely going to continue to push TLT higher because the market's going to continue pricing in those Fed rate cuts. All right, and the way that bonds work is if the Fed is cutting rate, typically you're going to see lower treasury yield rates, and if you see lower treasury yield rates, you're going to see higher prices in bonds. Very simple concept to pay attention to, right? So, from a trader standpoint, 94.74 is your resistance. Above there, we can come up here and tag the 200 SMA, which is going to be right around $97 by the time, by the time it takes to progress up towards those levels. Okay. Now the thing you want to be cautious of, okay, and another thing to really look for that trend of change in trend, not only would be a bearish CPI report, but also if we break this initial bullish divergence trend line, right? So we had these lows here, lows, lower lows, then we had low, higher low, higher low, higher low. So we had this point here where we were making lower lows but higher lows on the RSI. That was a bullish divergence, and we've held this trend line very nicely. If we were to break through here, that could be a signal potentially that, hey, the trend is changing and maybe it's time to look for a pullback in the TLT. You also want to pay close attention to your MACD. The daily MACD crossover has been a very good signal for buys and sells, but you can see over here the last time we got a bearish crossover, significant move to the downside. Then we got another bearish crossover here, significant move to the downside. And so if we were to get that bearish MACD crossover, break this trend line here on the RSI, it's very possible that, again, we could see that significant downtrend and potentially take TLT down to 87.67, if not lower. But, there's plenty of support to the upside above 87.67. And when we look at the 10-year treasury yield, again, it's also making sense. We're getting a little bit of a bounce here. We came down to our target. And the big question now is, can we get back below 4.187 and 4.128? If we were, all right, we have our 200-day moving average on the TNX creeping up. It's going to be right around 4.05. So if we do break those levels, 4.05 is going to be a key area of potential support, somewhere where the 10-year treasury yield could bounce. And below there, ultimately, the target is going to be 3.921. If we can get below 4% on the 10-year treasury yield, that's going to be a big key psychological level. And we're holding that 4% area right now at the moment. And really, it's just a good time to display some patience. Remember, cash is a position, and we can look to see and wait on some of the economic data. We have so much data, so many catalysts coming this week. You can wait and look to see, hey, do we potentially start a little bit of an uptrend here in the treasury yields that could result in TLT pulling back, or will we be able to break through and get below that 4% level on the 10-year treasury yield? That's really the main thing that I'm paying attention to when it comes to the TNX. Besides the daily MACD, right? If you take a look, the MACD is starting to curl up right here. If this curls above the red line, that would be a bullish crossover, and we would look to see if potentially we would get some continued bullish momentum in the TNX. For now, it's still a very strong downtrend. TLT is in a very strong uptrend, and the trend is your friend until the trend bends. So keep that in mind. Thank you guys for watching the video. Be sure to smash the like button, subscribe to the channel for more. Don't forget, you can always book me for one-on-one coaching sessions. I do one-on-one personal sessions all the time. You just head on over to the Ko-Fi page, click that commissions tab, and there you can book a 30-minute, or you can also book a 1-hour session directly through that platform. You can click on this buy a coffee button, basically as a way to leave a tip or donation for the free valuable content I put out to you guys, such as these videos, as well as the investment intelligence newsletter, right? Giving out free trade ideas, free finance content every single week. And if you're ready to join the Discord, the link is in the description. It's only $10 a month, less than a cup of coffee a week. And that's where you get access to all of the custom indicator scripts. That's where you get all of my chart layouts and flexible grids, as well as all of the different analysis and trade ideas as well.